If you have low credit scores, you're going to get a cheaper and better mortgage than if you have high credit scores. Have you heard that in the headlines? Because that is totally false. We are here to debunk that myth. My name is Albert Sousa. I'm with Mortgage Apex. I'm here with my friend.
I'm Charlie Cameron with the Military Home Team, and you've heard a lot of buzz lately about, certain policies coming into play that all of a sudden, you as a high credit score individual, someone who pays all their bills, are all of a sudden going to have to pay for folks with lower credit scores for their mortgages. You're going to pay more, they're going to pay less. So let's break this down and kind of debunk everything here, Albert.
Yeah, so what does that actually mean? There was some changes that were put into place for the LLPAs, which stands for Loan Level Pricing Adjustments. And these take into effect May 1st, 2023. So they're really into effect now. And what it said before is that if you had high credit scores, you would get a rate of here. And if you had low credit scores, you would get a rate of here. And so the pricing would change based on if you had high scores, if you had low scores. So if you had lower scores, you're going to get slightly worse rates than if you had higher scores. Now, what this change did, it didn't flip them, and it didn't make it so that low credit score borrowers get better rates than high credit score borrowers. That is absolutely not true, and that is what the mainstream media has kind of been painting as far as like the clickbaity titles and all that. But what actually is true is that this gap has just gotten compressed. So high credit score folks, you're absolutely still going to get better rates than lower credit score folks. However, that gap is compressed, so the pricing is going to be a little bit less advantageous. And the idea is to be able to encourage home ownership for some of the folks that are having a harder time getting into homes. So that's really what's going on here. It's not that it's better. It's not that it's all flipped. It's not that we're living in an upside down world. It is that it's simply compressed and made that gap smaller.
Yeah, so to just make it 100% clear, if you are working on getting a better credit score, you are going to have a better time getting a mortgage and a lower rate. So that doesn't change. Banks are still looking at that piece.
Don't start missing your mortgage payments because you're trying to get a better rate on your next deal. It's absolutely not going to work. So yeah, we can talk a little bit about the next part as far as like putting money down. Because there were some changes that happened there too.
Yeah, so a lot of people believe that by putting a lot more money down on a house that your rate's gonna be lower. So can we shed some light on that and then how this applies to that?
Absolutely. So oftentimes we will talk to folks and they'll say, I'm waiting to buy a house because I want to put 20% down or I want to put 10% down, because the perception is that if you're putting the minimum down payment of anywhere between 3 and 5%, that you're going to be severely penalized compared to somebody who's putting down 10% or 20%. And that is not true. So the difference between putting, let's say, 5% down and 10% down and 15% down and even 20% down is very small. Your rates are almost going to be unchanged. And so what these changes that happened recently is, again, made that gap even smaller. So now it's practically no difference if you put more money down as far as your rate goes. However, they did make some changes to PMI. So if you put less than 20% down, you have to pay PMI to ensure that the lender doesn't lose money in the event that you default. But that lowers the risk for the lender, which again makes it so that the rates are almost linear all the way through. So with this cheaper PMI, it ends up being a bit of a wash, and it's actually putting you in a little bit of a better position with the cheaper PMI.
Yeah, so this is something we kind of want to harp on just a little bit, because a lot of people believe, I got to save up more money. I got to make sure my payment gets smaller, so I've got to have more money to do that. That's actually not necessarily true in a lot of cases. And because of PMI actually makes risk lower for the lender. So in some cases, let's say you put 19% down instead of 20%, you'd actually have a lower interest rate on that 19% mortgage, and then could pretty quickly get to the point where you could cancel PMI.
Absolutely.
So it's really important to talk to your real estate team and truly have a team at your side that can walk through all of this kind of financial jargon and craziness with you, so that we can get to the best option for you. Because what works for Albert is not what works for Charlie, right? And what works for Charlie is not necessarily what works for you. But we could probably come to a good solution, and we don't want you to think that you're not qualified or that you're unable to do something when you potentially could be. Likewise, if putting 5% down, makes your interest rate lower, but also allows you to have more money in your pocket for things that could pop up with home ownership, we might want that to be the case depending on your financial situation. So we like to look at the big picture, right?
Absolutely. And we're huge proponents for reserves. Like if you saved up and did everything you could to save up 20% down, even if you have that money in the bank, we don't want you to scrape everything out of your bank account to go into homeownership, because there's costs that come along with it, and we want you to have some reserves. Like, you never know, life happens, right? So we want to make sure we're looking at your whole financial picture. That's something that we will always do. Maybe it's more advantageous for you to take those funds and pay off your car instead of putting more money on your home loan. But we'll look at that whole thing and be able to advise you on what's best for you. So long story short, 20% down is not always better. 5% down is not always better. It's all, what we look at it and what we make of it.
Right. And so let's talk a little about which loans this applies to and which it doesn't.
This is for conventional loans only. So these changes that came in place, they're for conventional loans. There have actually been changes that have come through recently for FHA loans and VA loans. So for FHA loans, the mortgage insurance, similar to PMI, has become cheaper across the board. For VA loans, the funding fees have gotten cheaper across the board. And now these changes are coming into place. And the bottom line is the powers that be are trying to make homeownership more achievable for folks out there so that more people can get into homes and start building wealth, because they know that that is the avenue for people to get to a point where they can pay off their home and live and retire comfortably. So they're trying to make changes to make it easier for you. And we've heard a lot of people up in arms about this change. And I'll say, no one's perfect. You miss 100% of the shots you don't take. So I would say that 2 out of 3, they're doing really good things, moving in the right direction. And that this one, it may not help as many folks as they were trying, but it's certainly not hurting folks as they're trying to paint the picture to make it seem.
Yeah, ultimately the goal is to help people get into more houses, especially as things have inflated and got quite a bit more expensive when it comes to home prices and, of course, the mortgage payments subsequently. So ultimately, we want to help you make the best decision possible. So if you need anything at all, feel free to reach out to us. Again, Albert, Mortgage Apex, Charlie Cameron, Military Home Team. We'd be happy to help.
Absolutely. Have a great day.